measuring and increasing profit. Okay, let's take a little recap, things you should already know before doing this tutorial. Profit is calculated by doing revenue minus costs. Gross profit, which is our large profit, remember, the one we get from our cost of sales, is purely revenue minus the cost of sales. And net profit is quite simply calculated by revenue minus all costs. So again, basically like calculating your profit. Remember, net profit sometimes is called your operating profit as well. Net profit margin. The net profit margin is the amount of profit that an organisation makes expressed as a percentage. Now you need to know this for your BUSS2 exam, but you'll probably need to know this for any other exams you're taking, or in the BTEC Finance exam for Unit 2. The formula is net profit divided by turnover times 100, and you need to learn that formula. Now remember, sometimes turnover has got other terms such as sales revenue. So you've got to look at that, and or revenue it might be called, and remember to put it in there. So net profit divided by turnover times 100, and this will show you what percentage profit you make. Okay, let's take a look at an example. So the net profit margin, the greater it is, the better the organisation is performing. You will need to pick out these figures from the income statement to be able to do this. So in the example below, I've got my £80,000 net profit, and I've got my £6 million turnover. And when I calculate it, I work out that I'm getting a profit margin of 1.33%. What do you think about that? I'm hoping you're thinking that's pretty bad. If you're running a business and making just 1.33%, you'd be questioning why. You want a much higher figure than that. Of course, it's better than a loss, but it's still a very small amount. Now, with net margin, there also goes the thing called gross profit margin. And strangely enough, this calculates how much profit you make on each item sold, and it's expressed as a percentage. And the formula, notice, is not much different to what you just learnt a minute ago. It is gross profit divided by turnover times 100. Now, this should be a bigger figure than the net profit margin. This is a greater figure, and this will tell you how much the business is making at every item they sell. So let's look at the example below. In the example below, I've got my gross profit of £3 million, and my turnover is £6 million, so that gives me a 50% margin. That means on every item I sell, I am making 50%. But of course, overall, I'm only making 1.33%. This must tell me that my overheads are way, way too high. Now, that's where your analysis comes in. You've got to start thinking, what do the figures tell you? Look at the figures in the exam and then try and use them to make a decision. You get lots of marks for this. The calculation you need to learn is what's called the return on capital. Now, this is the percentage return you get on the money you invest in the business. Now, this is calculated by net profit divided by capital invested. In other words, the money you invest in the business times 100. And this tells you as a percent what you get back from the money you invest in your business. Again, the higher the percentage, the better you're doing. And that's quite simple to calculate. Now, you also get asked a question to think about, how does a company improve its profitability? Now, I'm hoping you're thinking of the obvious things that I got on here. So, increase your selling price. However, you've got to then consider, what will that do to demand? Will that reduce your demand? That links nicely in with price elasticity. Is the item elastic or is it inelastic? If it's elastic, then it's going to have a massive effect on your demand. It's probably going to be more responsive, so it's going to damage your sales and maybe you'll make a lower amount of revenue. But if it's an inelastic product, then you're probably going to be fine. You can increase your selling price and actually make more money, so a greater profit. Or you could do the opposite. You could actually reduce costs. But again, what's the consequence of that? Is it going to reduce the quality of your product? Will that damage your reputation? Will that reduce the amount of added value you get from your items? Will that lose you customers and suppliers because of the fact that you are damaging your reputation? All factors you've got to consider. Or you could do a range of both. You could increase your selling price by a small amount and reduce your costs at the same time. Again, it's about playing them off. Remember, this is where the evaluation comes from in any exam that you're doing. Okay, that's it. You should be able to now calculate your profit margins and your return on capital employed, and you should be able to assess the methods that are used to create profitability. Don't forget to follow me on Twitter and subscribe to my YouTube channel, and you can check out my website, BeeBusinessBee.co.uk.